Tech stocks are losing steam as AI frenzy doubts are creeping into markets. Tech stocks have taken a beating this week, dragging down key US indexes. Investors are ditching long-time market leaders amid concerns the rally has gone too far and too fast. So is AI fatigue setting in and here to stay? Aoifinn Devitt is Senior Investment Advisor from Moneta. So the S&P 500 tech sector is down nearly 5% in the last 5 trading days. Should investors be worried?
I don't think this is really cause for worry. This is going to be now par for the course, I believe, in this sector. We're seeing stocks such as Palantir fall by up to 10% in a day. This is just the new normal. When we see valuations at these levels, Palantir was trading at 200 times earnings. We're going to have to expect a lot of intra-stock volatility. And that's why I'm starting to believe that investors need to think about their tech exposure a little differently from their other equity exposure. That will probably be trading at more reasonable valuations and behave really according to how equities have behaved. But these large tech stocks are a bit of a law unto themselves.
Some are blaming stretched valuation for the rotation. Is this a serious red flag for tech stocks?
It's certainly a cause for caution that one should not get carried away with hockey stick projections in an area which is really uncharted territory, such as the adoption of AI. We've been in this arms race where companies have been afraid not to put capex to work there. There's been a lot of talk about the productivity gains that could be expected and some hand-wringing about what that could mean for jobs. However, the reality on the ground is that nobody really knows what the productivity change will mean, and it really hasn't been tested yet. We're also seeing these mobile robots, and we don't know how they will ultimately affect the workforce. So I think definitely we got ahead of ourselves in terms of projections. What we do know, though, is that the picks and shovels, the demand for data centres, for infrastructure, for power, all of that is not changing. And that, I think, is a little bit of a safer bet for now than playing necessarily on the AI transformation.
Aoifinn, you did mention volatility and mega caps are making about 40% of the S&P's market cap. Will this volatility be limited to specific stocks or have a broader effect on the market?
Actually, overall market volatility is quite low. It's back to what it was pre-Liberation Day. And that kind of new normal is something that we were learning to expect when we had a low rate, low growth, low volatility era. So I'd say overall low volatility, the reason for that is because we have quite a high demand for equities and for growth in general. We do see money piling in from the sidelines whenever there's a correction. I think it's the intra-stock volatility we need to worry about. These stretched valuations, which actually are to some extent supported by earnings, by actual revenue, actual cash flow. That's the real kind of it's different this time narrative around tech stocks, that they are not just illusory valuations, they have some support. So I'd suggest that those valuations, because of where they are, they're going to be more volatile. Those stocks will be more volatile, not the other 493.
Well, MIT said that 95% of companies are getting zero return from their AI investments. Will we see some pullbacks in AI?
It's far too early to say. I mean, to the extent of which we now have a survey done that's looking at return from investment, I don't know how that could in any way be predictive of what AI will do. We know that the transmission effect of something like AI will be very prolonged. Transmission effects across the entire economy, from tariffs to interest rate rises, they are all being stretched out much longer than ever before. So I'd say that kind of MIT study is a snapshot in time. Perhaps a note of caution, and we certainly should not get carried away, but I would not like to predict from there that AI will not generate the productivity gains that we're expecting.
Of course, the outlook for interest rates is clouding investor sentiment as well. Do you think the Fed will give in to traders' desire and cut more this year?
I do think they will cut at one time, 25 basis points. I would be very surprised if they were to do a jumbo cut. When we look at, despite the jobs data, which is perhaps the only data on the basis of which they could do a jumbo cut, the economy is extremely resilient. We know that inflation is pushing upwards and still looking that bit higher, that bit choppier than we would have expected. We're also seeing that in the UK very firmly. So it would be highly surprising, given where we are with this US exceptionalism story that continues to run. You mentioned the tech correction, but before that we were at record highs. This is not the time to be cutting rates by anybody's rule book. So perhaps one cut just to give in to a bit of pressure and to ease this tension around these employment numbers. But other than that, I think we're going to see a lot coming out of Jackson Hole, but not necessarily anything more than one rate cut.
That was Aoifinn Devitt from Moneta. Don't forget, you can watch more videos on Reuters.com.